Good morning, everyone. My name is Chris Lopez, and this morning's webinar, we're going to be discussing the Denver real estate trends for multi-unit properties webinar. So I'm a realtor at Your Castle Real Estate, and our presenter today is Charles Roberts. Now, he's got a very impressive resume. He's the president of Your Castle Real Estate. He's an active realtor, and he's also a very successful investor. Now, before I turn the webinar over to him, I actually want to kind of do a deep dive into one of the acronyms he has on his resume, because it's very impressive, but often gets overlooked, and it's actually perfect for the webinar that we're discussing today. And that's the CCIM designation that he earned last year. So it often gets overlooked because it gets lumped in with the other acronyms, but it shouldn't be. It's a big deal, especially for someone who's a residential realtor and not a big time, commercial broker working multi-million-dollar transactions. So what is CCIM? CCIM stands for Certified Commercial Investment Member. And so it's geared towards commercial investment real estate, not residential. And they actually use very, very advanced financial modeling to calculate different forms of ROI. So if you think of like a hedge fund or one of these big state retirement funds that have 100 or 200 million dollars of income to place in real estate assets, they're using this type of financial modeling that Charles just did a deep dive into over the last year. And to become a CCIM member, it's not some weekend seminar you go to or one online class that you register for and spend an hour here, an hour there. No, it actually took Charles, I think he said 53 weeks to get all the education requirements finished over the last year and a half, and then it culminates with a 2-day exam. I think you actually have to fly to Atlanta, Georgia to go take this exam. So it's very tough. I haven't taken the classes, but I read excerpts from it and studied a few of the financial concepts, and it brought me back to like high school and college advanced math, and it's very advanced stuff. So I was actually in one of Charles's, actually I met Charles at one of his classes back in January, and he was talking about how he just completed his exam for becoming a CCIM. And I immediately thought to myself, why the hell is he a CCIM? Is he working with hedge funds? Like, what is he doing? Just because it's so much overkill for my perception what a residential realtor does. And I spent about 2 or 3 months as a commercial broker in Los Angeles working for a firm that focuses on 15 to 100 unit apartment buildings. So these typically go for anywhere from like $2 million to $20 million. So that's the typical transaction value. So we're talking big numbers here. And one of the newer guys at the firm started asking the seasoned brokers, hey, is becoming CCIM worth it? And all the seasoned guys unanimously said, no, it's not worth your time because we're too small. It's overkill for what we do. You don't need it unless you're in the 100+ unit range and you're working with like institutional investors. And so that's what these commercial brokers I work with are saying, whose average transaction was probably around $8 to $10 million. So it's overkill for them. It's really overkill for someone like Charles, who's a residential realtor. But it's actually, I'm very glad he spent a year doing it, and you should be as well, because it means he is incredibly qualified to go through the data today and actually do a deep dive into it. So to get things going here, 2 pieces of advice. Take notes. I've actually got a notepad next to me. Even though I'm hosting the webinar with Charles, I got a blank notepad next to me to take notes. I suggest you do the same. There'll be some great data. And please ask questions. Charles will go through this data, and if you ask him a question, there's a good chance he can do a deep dive into it, have a lot more fun with it, and actually lead to a really interesting discussion. So as Charles often jokes with me, he says, try to stump him. So if you've got like an advanced question, a hard question, go for it, ask for it. Charles enjoys those. So Charles, first, thank you for spending 53 weeks of the last year becoming CCM qualified And thanks to you for taking about an hour out of your morning on Saturday to cover this data. So welcome to the webinar.
Thanks, Chris. Hi, everybody. So I really appreciate that. And yeah, CCIM, boy, if you want to do your CCIM, come to me first, because it's tough. I don't actually have a finance background or anything like that, but it was very, very interesting, and it gives me just perspective. That's what this is all about, is understanding different ways of looking at things, and that's exactly what we're going to go into today, is look at perspective and look at the income side of our market. So let's kick right off. And as Chris said, please, lots of questions. Let's have some fun with this. Hopefully this is good use of your time. It'll be really fun for me to do this. So let's start with some key messages for income properties. Basically, the income market, let's call it duplexes and higher. Okay, we're talking not so much the commercial strip mall, hospital type of market, but more like multi-families is what we're talking about here. And we're going to compare duplexes to 10plexes and different things. But for the moment, we're talking about multi-unit properties. It's just been roaring, absolutely roaring. If you look right here, you see the average price per unit going from 2011 forward. That was basically the bottom of the market, was 2011. In the next couple of slides, I'll show you that. It's just incredible. 2011 to 12, up 18%. The next year, another 20, another 14, another 17, another 22, just going up and going up. Now, we suffered a big downturn, as I'll show you in the following slides. But what I can tell you is this, that you hear a lot people say, well, the commercial market always leads the residential market by 2 years, or condos are always 6 months behind single families, or none of that I buy, because I actually look at the data, and the data actually has shown in the last couple of cycles here in Denver that the residential market is actually pretty darn similar to the multi-unit market. Things go up, things go down, they go back up, and this right here, while dramatic, is actually quite similar to what we've seen in just the normal residential single-family homes, condos, townhomes type of market. I'm also going to talk about the number sold, which is a function of the inventory. Now, look at these numbers, going up about 20% a year, and then look at these numbers. Wow. Big, big difference. Volume is way off. Went down 8%, down 26%, up 3, down 8, down 5. And that's exactly, once again, what we see in the residential market, is that there is no inventory. There's an enormous amount of demand, and what you see, Economics 101, is the prices going up. And that's exactly what has been happening. Days on market, shouldn't be surprising that the days on market have plummeted down 26, 14, 17, 17, 9, just plummeted days on market because there's more demand than supply. You don't have to go much further to understand that. Months of inventory, again, very similar to days on market, very, very low months of inventory. And typically what you see with multi-units is you have longer months of inventory. It takes longer to sell these things, and yet we're down, was that July of 17, the number was 2.4 months of inventory, incredibly low. So the key messages are the multi-unit market is very, very strong right now and has been for a while, and I'm going to get into more details now. If you have any questions, I got Chris standing by right here. Just feel free to type them in. We'll see them come in, and we will address them one at a time. So just jump in anytime you want. In the meantime, I'll keep going.
I'll say just, I know we got a late start, but can you enlarge your PowerPoint and make it easier for people to see that, like go into presentation mode or enlarge it?
Sorry about that.
Yeah. There we go.
Does that help?
Yeah, that'll be a lot easier for our viewers to see.
And also, if they see it in a small screen, they want to click the little arrow, I think, that actually makes it larger on theirs. Is that right?
Yeah, or there should be a zoom button with a magnifying glass across the top of the bar that you can use to zoom in and enlarge that way.
Okay, great. So income property prices, what has happened since 2007 going into the downturn? Let's look at this in detail. The average price per unit went down 50% between 07 and 09. Now, I don't know about you, but I owned these types of properties. I actually still own them, but I had a portfolio and still have these types of properties going into the downturn. And I suffered like everybody else. I watched the prices go down, and it was tough. So let's look right here, 2007. Let me explain what's happening. The green, this line here, are the 2 to 4 units. And the way we did it, and we thought a lot about this, we wanted to figure out what the best way to represent units of different sizes, because obviously you can't compare a 2-unit to a 5-unit in terms of the purchase price. We broke it out price per unit. So this right here says that in 2007, the average price per unit of a 2 to 4 unit was $115,000, meaning a duplex average price was $230,000 and a fourplex was $460,000. Okay, that's what was going on right here, price per unit. And what happened as we hit the downturn is the prices just plummeted. It was scary. It was awful, and it went like this, down and down and down and down and down into 2009. So we went from about $115,000 per unit to $72,000. You do that math, that is a 50% drop in the price of your portfolio. And that's exactly what I went through. I had these properties, and that's exactly why a lot of investors who were, I don't know, over leveraged or under motivated to work 100 hours a week to figure it out, lost all their properties. And that's what happens during a downturn. And we saw it happen here. What you see here are the 5+ units. So for those of you more interested in the larger multi-units, we track that as well. The average unit price in 07 for a 5+ unit was $77,000, and you saw it go down to $49,000. Also a dramatic, although not quite as dramatic drop. And then if you like this is the all units. Purple is basically it. So we want you to basically track what you want to track. I'm going to concentrate on the 2 to 4 units because I think most of you aren't 100-unit people. You're probably kind of like me and my investors, you know, small-time folks who want to buy some properties, single families, duplexes, fourplexes, stuff like that. So what we saw is we went from here all the way down, and now let's look at what's happened since then. And I'll tell you, it's almost chilling to see this type of line, because when we were here and here and here, I got to tell you, I never thought we would be here in 2017. We went from $115,000 a unit to $72,000. We are now at $220,000 per unit right now. And I'll tell you, I have a duplex, the second duplex I ever bought. This one was in 1999 on Winona Court, south of Sloan's Lake. And it's funny to me because these numbers are exactly what I went through. It was worth about $230,000 in 07, and it dropped down to about, you know, $160,000 just a couple of years later. And that is a tough thing to see. And that particular market, a couple of blocks south of Sloan's Lake, has just come back so strong with the Sloan's Lake effect that it's worth about, you know, it's worth about $500,000 is what the all the duplexes around me are being split up, and they're being condoized and, you know, made beautiful and stuff like
500
that.
Per unit or 500?
500 total. Sorry, yeah. So this right here, the average is 220. Mine are about 250, or about $500,000. Just this one happens to be exactly on this trajectory. So the lesson here is to understand, of course, that prices go up for a while, they go down for a while, they go up for a while. And if you look at 30-year averages, 50-year averages, you see it all over the place. The question, of course, you're asking that you're waiting for me to get to is, well, what does the future hold? The answer is, of course, we don't know, but through the next couple of slides, I'm going to tell you that my best guess is that I think this market is going to stay for a while. I have no intention of selling, and actually most of the people, if not all of the people I know in this business who own properties, really have no intention of selling, which is exactly why there's no inventory, which is leading to the increased prices. That's the dynamic. That's what's going on in this market. I'm going to look at Chris right now. Just any questions from you or anything I should be talking about that I haven't yet?
Now, you may get this in a future slide, but did rents drop by 50% down here in the downturn, or is that, am I jumping ahead?
No, that's a great question. I'm so glad you asked. Okay, because that is a very, very common question, and it makes perfect sense. What happened to rents? So some of you out there, I know, you know, we have a whole bunch of people on this on this webinar, and I think you might have experienced what I experienced. If you didn't, let me know. So the value of my properties during the downturn went down dramatically. I had lower end properties, great cash flow, but tough neighborhoods that I had to work really hard to keep rented. While the values of the properties went down 40 to 50%, in my experience, rents went down 10 to 14%, right in there, okay? They did go down, but they didn't go down that much. What went down for sure wasn't the rents, it was the quality of the tenant. And I basically had to make a decision to deal with the tenants or pretty much lose my properties. And me and everybody around the country had to make that decision, because that's exactly the phenomenon that occurred, not just in Denver, not just in Colorado, but everywhere during this downturn. Rents did go down somewhat, and we have a lot of historical analysis and data to support that. But no, they didn't go down 50% at all. So that makes me a little bit comforted, because someday we're going to have another downturn, and I have every reason to believe it's going to be the same thing. The quality of tenants will go down. We have an incredible luxury right now where we're getting such great tenants who behave themselves because there are no places to rent, and the prices and the rents are going up. So I think the rents will go down, but no, I don't think it'll go down dramatically, because it didn't last time. And we hit 13.4% vacancy. I'll show you that in the slide coming up, and I'll show you exactly what rents did.
Okay.
Again, if you have any questions, just type them in. We're looking at it and we'd love to answer them. So let's look at the income property units sold. The interesting thing is that while prices have changed dramatically over this period of time, the number of sales hasn't changed that dramatically. Sales volume has been surprisingly stable. So let's stick again with the 2 to 4 units, because I think that's what most of you are interested in. Going into 2008, these were the numbers. There were, for example, in this quarter, there were 64 duplexes to fourplexes sold. And then 87, 92. And then look at this. It just kind of has crept up a little bit, but going back here, you had, 60 or 70. All the way into 2017, you have, about 80 something. It hasn't changed very much. And if you're thinking that it would be different with 5+ units, I mean, that is as stable as you could. There is no such thing in real estate that is that stable for a period of 10 years. Literally hasn't changed. So what you're seeing and what you're hearing a lot about is a great deal of interest in Denver. And this is not something new. This has been going on for 5, 6, 7 years. Big money coming into Denver, REITs, national organizations buying more of these, of course. And yet there aren't that many for sale. That's the bottom line. There just aren't that many for sale. So we don't see the numbers of sales actually going up. The result is more demand, less supply, prices go up. That's exactly what's been happening.
Now, do you know, does this data include like new build and all the new construction going on? Is that in this data, or is that a separate data slide?
It could be a mixture of both. So if you look right here, we cite our source, which is RE Colorado in the bottom left. So it's everything from RE Colorado. So there definitely could be, there absolutely are some that aren't here. What we can tell you is that it's not like we sourced RE Colorado here, didn't here, and then did here. From the perspective of everything on RE Colorado, it has stayed stable. But yes, there definitely are some, especially in the larger stuff, that wouldn't be on RE Colorado, no question about it.
Okay.
But what has been listed hasn't gone up. It has a little bit on the 2 to 4 units, but not much. And I guess I would ask you this: if you own a duplex and you've owned it since the mid-90s, are you listing it? Great, I'll list it for you. I'd love to list it for you. My guess is you don't want to sell it, because I don't want to sell mine. Rents are so high, tenants are so solid these days that it's a really easy argument to say, nope, I'll just hold on to them for now. That's what we're hearing. Let's look at now days on market. So as you can see, all of these things are related. The prices, the inventory, days on market related. Marketing times have plummeted below pre-recession levels. And let me show you why. Let's go back again to the 2 to 4 units right here. So we were looking at 129, 130 days on market, okay, which is 6 months of on market. So it's, that was relatively high right here during the downturn, and you saw it even go up, and that was less fun than it could have been. And it actually went up even more here. But look, it peaked around 2011, halfway through, similar to where the bottom of the market was. And as you would expect, as the market got stronger, the days on market went down and down and down and down and down. And now it's at about 73 days on market. And that's the lowest in recorded history for multi-units in Metro Denver. No surprise there. For the 5 units, 5 units, bigger properties, certainly a lot more analysis. I mean, an appraisal takes, like a month to do, and inspections are $5,000. It's a much longer process when you're dealing with bigger buildings. But again, you can see that they track actually really closely. Isn't that interesting? Peak here, go down, peak here. It's really kind of neat that our little duplexes actually track very closely with the dynamics of 50 and 100 unit properties. And then of course they peaked here and are down to record lows. So it's the same thing over and over and over again. You have lots of demand, not a lot of supply, and not a lot of building. Of course, we have the whole construction defects stuff going on here that affected some of the building. That has been resolved if you're someone who wants to potentially see more for sale condos being constructed, just depending upon your point of view. But the big picture here is that income property days on market have plummeted.
Now you're talking about how the 2 to 4 units and the 5+ units track together is like one's the chicken, which one's the egg? Is one the leading indicator and one's the trailing indicator? Or are they just parallel, do you think, in your years of studying this data?
Parallel. So the last thing I would ever do is to pretend I'm so smart that I can figure out which one came first. Of course you can't. And I for those of you listening, it drives me crazy when I hear agents sort of try to sound smart by saying, once again, condos are a leading indicator, or commercial is always 2 years behind residential, or things like that. Here's a perfect example of duplexes actually having almost identical days on market properties as large units. I mean, this is a great example of it. I mean, you tell me if you can get anything out of this chicken and the egg wise. You can't. They basically run along, and that there is. We talked about perspective at the beginning of the webinar. This is part of the perspective. Is don't do the chicken and the egg thing,
okay?
Because it's not really going to work. Certainly, it doesn't work here. Yep. Great. Okay, we'll keep on going, and once again, pop in any questions. We're here to help. So this is a fun slide. I want to spend a little bit of time on this one. This is the market trends, the rent and vacancy. And this is Apartment Association of Metro Denver data. And they do a great job. They actually send out surveys once a quarter to tens of thousands of property managers and little landlords like me. And this is what they get the data. They just take all this data and they produce these like 50-page reports. And if you're interested, pop me an email. I'd be happy to forward you some recent reports. I mean, if you like data, this is big time data. What we did is we just took a couple of their slides, citing them of course, and put the vacancy rate by quarter slide over the median rent by quarter slide so that you can see how they relate, and they relate really, really well. So a couple things I want to get out of this. So let me start. 1981 to present day. So in 1981, the vacancy rate was incredibly low, and rents had been going up for a little while. But over the course of a number of years, say 81 to 86, 87, vacancy rates went from about 2% up to 13, 14%. They skyrocketed. And what do you see? You see exactly what you expect to see. Rent growth, the average rental increases just stops. And for a 10-year period here, the average rent growth was 0.3% per year. And by the way, you know what the inflation rate was during this period of time?
It was more than 0.3%. I know that.
Wicked high.
Yeah.
So if you were a landlord and a building owner, you were getting crushed here because your rents didn't go up for a decade, and you were suffering through 6, 7, 10% inflation rates, which meant, of course, that your real income was going down every single year. The point is that when you have high vacancy rates, what you see is low to no rent growth. But then things change. So economy starts getting better, vacancy rates go down, and then you see this amazing 10-year period here where the average rent growth went up 9.5%. So if you do the rule of 72, 72 divided by 9.5 is like 7 or so. That means that rents doubled in 7 years.
So they made up for the previous 10 years.
Yeah, but you have to have a lot of patience. That's one of the perspectives I want to bring to this.
Cash reserves.
Cash reserves and business abilities and perspective to know that over 17 years you might actually do okay. But let's say you bought right here. You've got 5 years of this going down. There's a real lesson to be learned here. Part of the lesson is to understand that, of course, there is a relationship between vacancies and rents. When you have low vacancies, like 4.7% average for this period of time, you have enormous rent growth. And if you don't believe it here and here, let me show you again what happened. So vacancies just started to rise again here during this period, and we peaked at 13.4% or something like that right here in 2003. And of course, what do you see rents do? They rose for 10, 12 years, and then all of a sudden they stop, and they go down a little bit, right? And that's what you see now again, another 10-year period where you have relatively high vacancies. You have 0.8% growth in rents per year.
So lower than inflation.
Lower than inflation again. So I started buying right around here. I had a couple of good weeks, and then boom, I had about 10, 11 years of just like nothing. Just wow. No one told me that rents wouldn't go up for 10 years, but yeah, that's exactly what happened during this period of time. So, like happens in economics, things change over long periods of time. You have very low vacancies. And now let's talk about the last couple of years. And this is what everybody is hearing about and talking about. Rents have skyrocketed the last couple of years, gone up 40%, 10.8% average the last 4 years. And that's what you're hearing about. Why has it been going up? Of course, because we have very low vacancy. I'm going to talk in another slide or two where I think rents are going to go, at least for some period of time, and I'm going to talk about the affordability. But what I want to leave you with in this graphic is this. This right here, from 1981 all the way to present day, is a 4% average rent growth. And these, by the way, are for 5+ units, so these are for multi-units, but it's very, very similar dynamic for the single families and duplexes and stuff like that. So while you might say, well, rents are just crazy, they're too high, don't forget, this right here, for this 17-year period, is also about 4%. This is the point of perspective. Don't look a week or a month back. It's so important to understand long periods of time, to understand that there are surges, and then there are long flats, and then there are surges. Nothing I can do to control that. That's just the way real estate works.
I'm curious. I know you're starting to get into your investing in the late 90s there, Charles, probably kind of towards the end of that nice rent run up from a landlord's perspective. Was there talk in the media and talk in the real estate market back then about how much rents had gone up and then affordability kind of like similar to today's, or do you remember?
No, I don't actually. That's a really good question. There probably was, but I wasn't paying attention. I didn't know anything. So I don't know. If someone knows how to answer that question, let me know. Someone older and wiser than me. I would assume so, but yeah, I was just a guy who bought a duplex or two, and kind of got started. So lots to learn here about long periods of time. What happens? Vacancy rates stay low, rents are going to go up. Eventually, will vacancy rates go up? Yeah, I do think so. And that'll start to curtail the rents. So this one is a scatter chart, and it's a little confusing, so let me spend a moment just explaining why we do it this way. There's a clear link, as we saw in the previous slide, between occupancy or vacancy rates and rent growth. What we're saying here is this is 30 years of data, and all we're saying is when the occupancy is high, meaning low vacancy, you see high rent growth. And then when the occupancy is low, meaning high vacancy, you see low rent growth, or rents actually go down. So for you economics majors, I wanted to throw in a scatter chart so that you can see the same information that we had basically in the previous slide. There is absolutely a correspondence. But here's the danger. The danger is taking a slide like this and thinking you can figure out what's going to happen next week or next year, and that I really, really counsel you to be careful, because while I can have guesses, you can have guesses, I would not spend all my money thinking that I know exactly what the market's going to do in the near term. Long term, I'm going to guess 4% rent increase, maybe more or less keeping up with inflation over the next 20 years. That's what I learned from this. What I don't learn from this is to say, I just read a Zillow article and rents are going to plummet in October of 2018. That is silliness, and I believe that is stuff you get from people trying to sell you something. So obviously not a big advocate of that. But you do see pretty clear trends. Low vacancy, high rent growth. That's enough for me.
Now, just to kind of a little side tangent here, Charles, I know briefly what CSAM entails, and a lot of it kind of takes the bigger picture market perspective. It's in the classes, right? Do they even tried to bring correlations into there, or talk about how, some trends or indicators affect this stuff, or do they ever kind of dive into this?
Yeah, it's a great question because, you think you hang around with the smartest people. And I'm in classes with people who like the students run REITs, never mind the professors, the teachers who actually do this. They're professors, they literally are people who do huge developments around the country and around the world. Really, really impressive. Let me give you a quick story. One of the guys was probably about a 50-year-old guy, great guy, and he ran a REIT, like $1 billion REIT. Super guy. He was our teacher for CCIM 102, and he was talking about a development that they were working on, that they were going to be done around 2020 with the whole development. And one of the people in the class asked that question, like, well, when do you think you're going to sell? And he looks at him, and he wasn't being funny. He's like, I don't know. And the guy's like, what do you mean? It's like, I don't know. That's a bunch of years out. Like, well, I don't know, 2022, 2023. We'll start looking at the market again. But how the hell should I know when we're going to sell? Like, I don't know what the market's going to be. And I'll tell you, that affected me so much because what I find is the people who understand this business the most are the ones confident enough to say, yeah, I got $1 billion on the line. I don't know what the market's going to do. I'm going to monitor it. And it's the people who have been in business for 2 days who think they know what the future holds. That, to me, was an incredibly valuable lesson.
And that's something I found really intriguing as I've kind of hung around you and just other people really familiar with this data, is that actually the more you know, it's almost a more simplistic view you take. And they're like, you know what? There's a few options, but I don't say simplistic in a bad way, but don't get caught up on all these little details and trying to time the market. Just here's what it currently is, and we'll make decisions when we get there, but we can't pretend that we know 5 or 6 years out what's going to happen. Yep. So we got a couple questions coming in here. So Chris Ott is asking you, Charles, how will the population growth or no growth impact the rental market? I.e., do you track demographics to help explain or anticipate market conditions?
Yeah, that's a great question, Chris. So yes, I think it's all about population growth. So, for our friends in, Detroit or places like that, they're wonderful cities, but unfortunately they're getting depopulated. Guess what's happening? Prices have gone down. For much of the southwest of the country, and Denver certainly being a target there, people want to live here. I'm from Boston. I don't know where you are, but I'll bet you 65% of the people listening right now are not from Denver. They have moved here because it's a wonderful place to live. And yes, that is what it's all about. So Patty Silverstein, who's a local demographer, has calculated that she is expecting about 500,000 growth to our population in the next 10 years. To me, it's not that complicated. If she's right, which I do think she's probably going to be roughly right, people are going to move here. We're going to go from 3 million to 3.5 million people. Those people are going to need to live somewhere, and I want to rent them a few units. It's really just not much more complicated than that. We've had times when we actually had depopulation. 2003 and 2005, we actually had more people leave Denver than come. It can happen even to a great place like Denver. We had high unemployment and people had to leave. Guess what? It crushed our vacancy rates. That could happen again, but I'm a 20-year guy. I don't really care about next week or next month because I can't control that. In 20 years, we're going to have a lot more people here in Denver, and people who buy and hold property, I think, are going to be glad they did.
So Kyle asked a similar follow-up question. With all the people forecasted that will be moving to Denver, should rental rates stay strong over the foreseeable future?
Yeah, my crystal ball is, yeah, of course they should. My best guess is I don't think rental rates are going to go down for the foreseeable future. We are not building a lot of lower to middle income rental properties, and that's where most of us don't buy, 700,000 penthouses downtown that's being built up. That's great. I'll leave that to someone else. Most of us, I'm going out today with a client who's got some 1031 money, and he needs, 200,000, a 3.1, a 3.2 with a 7.5 cap rate. Nobody is building those. They're just, the builders can't afford to build them. So that's exactly what's happening, is that because we have no or very little supply of these types of rentals coming in the market, but we have crowds of people moving to Denver and basically clogging up the fast lanes on I-25, yeah, I don't think it's much more complicated than I expect rents to remain strong for a period of time. And by that, I mean years is my guess, just a guess.
And now Cormac asked, Charles, how does growth in the number of brokerages that do off-market or pre-MLS transactions impact this?
So Cormac, what an interesting name you have, Cormac McCarthy. Great writer as well, so I'm sure you hear that a lot. So how does the growth in the number of brokerages that do off-market pre-MLS transactions impact this? I have no idea. Is there a growth in the number of brokerages that do off-market pre-MLS transactions? I guess if you wouldn't mind, Cormac, come back and let me know what data you're talking about, because I mean, did it grow since last week or 5 years ago or 20 years ago? I mean, I've been doing this 20 years, and I don't know that there's actually more brokerages doing off-market than there were 10 or 15 years ago. There might be, but I don't think it has anything to do with it, in my opinion. If somebody knows more, let me know, but it's not really anything I think about. There's a lot of investors out there. It's very competitive, whether they're realtors or licensed agents or out-of-town people or wholesalers. There's always been lots and lots of competition for properties here, but I guess all I can say is I don't even know if there are more off-market stuff going on than there was 5 or 10 years ago. My best guess is there isn't. I mean, I was doing this back then, and there was always been lots of competition. So if you have a follow-up, please let me know, but I'm not sure how to answer it.
Probably no way to really track it, because I mean the MLS is nice because you got a centralized system that tracks everything, or if you're doing an off MLS deal, it's between two individuals, and what third party's tracking that. And
I know that people always love to say, oh, there's so many more investors than there were 3 days ago, but that's just not true. Once again, perspective. You do this for a while, not a week goes by when I don't hear that. Lots of investors get out of the market because it's hard to invest, and people get frustrated, especially fix and flippers. They find that it's more difficult than some sort of HGTV television show suggests. So there's a lot of fallout. So not to be too cute about it, but I don't know how to answer that question because I don't actually know that there are more people looking. Great questions. Keep them coming. I'll hit you with the next slide here. Okay, so this one it's really important because what we hear a lot about these days, and for the last several years, is affordability. Is that rentals are unaffordable, and that's the only thing anybody knows about rents in this market, is that rents are unaffordable. So let me counter that with actually some data as opposed to non-data when people say that rents are unaffordable. And I'm going to go through a couple of graphics here to get to my point. So this right here is the Denver average rents, okay? And this is with inflation. So basically, back in 1981, you paid like, $375 for the average rental. And today, you're spending about $1,350. But what's very important to understand is that inflation and wage growth have actually diminished what this number looks like. So what the media, what everybody looks at is this number. But all you have to do is understand that wage growth over here and inflation affect it, to understand that in real dollars, the average rents actually are at a high historically, but not above previous highs. What it makes you understand is the perspective that looks incredibly scary, this looks less scary. Let me keep going. The Denver average rents are here, then the Denver per capita income is here. And what you're going to notice is this line looks a lot like this line, okay? And what this says is, yes, rents have gone up a lot since 1981, but you know what? So has the average per capita income. You solve all of this. We just do a simple analysis of rent as a percentage of per capita income. And let me walk you through this. In the 80s, rents as a percentage of per capita income were very, very high. This was tough. 29, 30, 31% of the average person, average renter's income was going to rents. It went down, 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 plummeted, and then came back, went down again. And now let me show you sort of recent history. What happened during this period of time when we had the really high vacancies is it became really, really affordable to rent. We had record low. Renters, wow, it was so great. Only 20% of the average renter's income went to rents. Nobody talks about that. All everybody talks about is what's happened since 2001, which is absolutely true. It is absolutely true that since 2001, rents have skyrocketed and rent as a percentage of the per capita income has gone up. Why? Because per capita income has not gone up much in the last 6 years while rents have. But understand that where we are is just a little bit above our average 24% based on our analysis. Our analysis shows us that over this period of time, since 1981, the rent as a percentage of per capita income has been about 24%. We're at about 25.5% now. Yes, we are above the average, and yes, it's been very tough the last few years, but I ask you this, if you're a landlord, if you put something on Craigslist or GoSection8.com or a couple of the other sites, can you find a tenant? Can you find 10 tenants? Yes. All I'm doing is I'm showing you, I'm giving you the data for what every landlord knows, that people can still afford it. There is no question we have 1.5% vacancy for single-family duplex properties today. Why? This tells you why, because people can still afford it. Now, what I will tell you is that historically, if this goes high, high, high like this, if wages don't start to keep up, of course, we're going to get to a point where people will not be able to afford the rents, and that is exactly what is going to curtail the rents at some point. My best guess is we are a few years off. We actually just had, in our latest report, Denver wages actually went up. Finally, they're kind of going up a little bit, starting to catch up. But I have every reason to believe that this is going to continue to go up for a while, for a few years, and then it will start to level off. And that's my best guess on rents, is that we have a few more years of pretty strong rent growth, and then we'll get back to that kind of 4-year average. This is the type of stuff that you get up early in the morning and you read stuff late at night to understand insights that other people just don't have the patience or the ability to understand. But this is a really, really important point, that while of course rents have become less affordable since 2011, let's not forget that 2011 was an all-time affordability high for renters. That's what perspective brings to the table.
Now, is there any, I'm looking at these first two graphs over here, Charles, is there any significance behind the without inflation and the inflation lines converging, or is that just, is there any significance behind that?
As you get closer, they're going to converge. So they're going to start way separate, but yeah, the way these analyses work is that they basically will become the same thing when you get to that point. The important thing is to see where it starts from.
So you were saying, I'm sorry to interrupt, so you were saying like in 20 years out, we do this graph again, it'll be the same thing, it'll be,
yeah, exactly.
It'll start, so it's always just present time they converge?
Exactly, okay. Yeah. And the payoff is this. This is where it all comes together to compare. Basically, you're comparing that line to that line, and then you get this line, and understand, wow, that's a tough time for tenants, great time for landlords. This is a great time for tenants, terrible time for landlords, and this right here is average, and this right here is where we are right now. So we expect this to go up a little bit, continue going up. If we start to get some wage growth of 3, 4, 5%, that'll extend the curve. As far as I'm concerned, that'll be good for landlords, and we'll be able to continue that rent growth. If we don't get that, yeah, I expect that to curtail, and we'll go back to probably historical norms of 4% with maybe a couple of years of, dropping rent growth over the next 5 or 10 years, something like that.
Great, thank you.
Great. So, pretty much, is this the last slide? Yeah, so that's the last slide. Thanks for hanging with us, and it's really, really great. We look at our numbers, and we see like every single person on this live webinar stayed on, so I really, really appreciate your time. If you have any questions, throw them in. We'll spend another minute or two just kind of talking about this stuff, and then also invite you to come to our website if you haven't been to it. Chris, why don't you talk about this a little bit?
Yeah, so my background is actually I've done a lot of marketing and online stuff, and I got the good fortune to meet Charles, and so I was able to say, hey, Charles, can I pick your brain and just kind of take all these wonderful resources and data that you and your cast real estate puts together? And he said, yeah, let's do it. So we came up with a website, denverinvestmentrealestate.com, and it's just kind of like an ongoing, or it's a website that has kind of an ongoing conversation with the latest data and various topics on there. And one thing I do want to point out, could you actually pull up that website, Charles? Should you pull up Internet Explorer and go to it, or Chrome or whatever? Because we generally do 2 webinars a month. One will be like this, kind of like a class that Charles normally teaches in person, but we do it on the webinar. And at the end of each month, we're actually doing something called our monthly roundup. And that is something where usually Charles, myself, and if we can make it work with a couple of our experts around Denver, we'll bring them on as well, and we just kind of talk about news or transactions and just things that happened in the previous month. And I would love it if you guys came there and join us. Think about it like a virtual cup of coffee to come, hang out with us. So just to get the details, go to Education, Webinars, and all the schedule will be posted up top here and recordings below, but that's where you get the latest information for upcoming webinars. Something else, and I know this is something Charles and I just started talking about a couple weeks ago, but it's actually looking a lot more into the 5 to 10 unit multifamilies. So getting in that commercial world, because Charles obviously has that background with the CCIM. I spent a few months in the commercial world and have an interest in there. And we're actually doing a lot more, some data analysis for the 5 to 10 units. And I don't have a whole lot to speak on there yet, Charles. I know we haven't done much research. Any information you can share on there, or kind of like a teaser to know?
Yeah, sort of a teaser is that I have folks with a lot of money sometimes, and they think they want to buy multis. We look at them, and more often than not, we don't buy the larger multifamilies because the cap rates just aren't as good. There has to be another reason oftentimes, like they just don't want to buy 6 or 8 properties. They just want to buy 1 10-unit, something like that. But they might have to get a low 6 cap versus a mid 7s cap. So we're going to look at this a lot more closely. We have CoStar, which is the commercial, essentially the commercial MLS. So we have access to all that. I have that. And I want to just dig more into this because I've been teaching my clients who think that they want buildings to understand that it's about cap rate and it's about what's right for them. And more often than not, we've been staying away from them. But we have seen a few properties that make sense in the 7, sometimes even the low 8 caps on the multi-unit. So we thought we'd bring that information to you. So whether you're an agent or a client or something, if you're looking and want some more data from someone who understands this stuff, we're going to start bringing that down the road.
And the final thing as we wrap up, as you already mentioned, Charles, throughout this webinar and past ones, people say, oh, well, Denver is, just becoming unaffordable. Again, it's kind of relative to your perspective. Well, let me ask you this. How many properties do you have under contract now for investors?
Okay, I have 9 under contract and 2 were listings, so 7. Right now I have 7 under contract for investors.
Yeah, so right there. So currently 7 properties under contract for investors. And what, these are probably mostly around 7.5?
7.2 to 7.7 caps. Yeah, they're all quite similar. Condos, townhomes, they're all in good shape just because there's very, very few beat up properties out there. They're generally kind of turnkey, rent them and maybe do a little paint and a little fixing up, but I think everyone we have is just about ready to go, and they're all in the about mid-7s caps. Just decent cash flow, the type of property that if you buy it, put it on a 15-year loan and make 1 extra payment per year with all your cash flow, you'll pay off in 12 and a half years, those types of properties.
So the reason I ask you that is because, that is, proof today that there's still good deals out there for, buy and holds to build long-term wealth. So if you want to look at properties, got questions, obviously reach out to us. We're more than happy to discuss it. And if you want to see some case studies, go to the website, go to Education and Case Studies, and we've got a few write-ups of some properties that we've helped clients get in this last year, and you can kind of see the numbers, what the properties look like, and some commentary.
So Mandana, thanks for actually joining us. She has a great question. She says, hello, Charles. Could you talk about Denver property tax increase of 35% affecting income property owners? And yeah, that's very true. Our property in the last evaluation, it's every 2 years, taxes absolutely have gone up. Why? Because prices have gone up. So it's not that the tax rates have gone up. So this is, once again, perspective. So back in 2006, you had a $300,000 property and you had X taxes. And then it went down 50%. And guess what? Your taxes went down. But nobody said, oh, life is good because you just saved $400 in taxes. Everybody said life sucks because you just lost $150,000 in equity. Now the opposite is happening. That $150,000 property that you had X in taxes is now worth $300, and now you're paying more taxes. So the answer is yes, taxes have gone up, but do I complain about my taxes going up a few $100s when I've made so much more? Honestly, Mandana, I don't. To me, yeah, that's one of the line items in my analysis and my spreadsheets are taxes. What's important to understand is that our taxes relative to many other communities, Chicago and certainly back east and stuff, our taxes are much lower than they are. And while our taxes have gone up, it's not the tax rate that has gone up. It has been the fact that we're making so much money on capital gains that, our properties are worth more, so we're making more taxes. So while nobody likes paying more taxes, if I make $100,000 in equity and I have to pay $400 more per year in taxes, that's part of the game. So that's pretty much how I feel about it.
Great. Another question coming in here from Mark. He says, with properties in such good shape, does the BRRRR, which is a shorthand for buy, rehab, rent, refinance, repeat, model work for your clients?
Great question. I will tell you that back in 07, 08, 09, we were doing so much more of that. Why? Because we were buying distressed properties, and distressed properties almost by definition are like all sort of BRRRR-ish. They need a lot of work. So we were buying stuff for $70,000 in Denver Southwest, in Commerce City, in Aurora North, and that was the perfect BRRRR strategy because you bought them, you rehabbed them, you rented them, you refinanced. That's exactly how I started 20 years ago. The answer is yes, it sort of works in theory, but in fact, we're not doing that much anymore. Because the market has gotten so strong, there are relatively few beat-up properties out there. Why? Because most owners, especially who are counseled by good real estate agents, if they are, understand just do the work yourself. You make a lot more money selling it to a first-time home buyer than selling it to an investor at 60%. So while I'll bet you 90% of the properties that we were buying in 08 and 09 were beat up that needed rehab, right now, I can't remember the last one, 5%, something like that of what we're buying need rehab. So that particular BRRRR strategy, in a sense, doesn't work as well, but it's all pros and cons. Some people actually don't want to be adding the value to those. They want fixed-up properties. The very short answer is there are way fewer fix-ups in today's market than there were during the downturn.
So here is a kind of a great question, also a loaded one. So have your coffee, Charles, and get ready for this. So here's a broad question. If you had $100,000 to use for investment, what would you buy? A couple of condos, a duplex, a single family, what?
Just want to respond to Mark saying, thanks, that's my problem lately as well. You're right, Mark, you're seeing exactly what we're saying, that there's just not a lot of beat-up properties out there. Okay, Cheryl, that is a wonderful question that, I'd love to spend 2 hours with you and talk about it because it's not a quick one. I will tell you that I just bought 6 properties the last year and a half, so I just added a bunch to my portfolio. What I bought were condos and townhomes that were already, 4 of them were totally fixed up and 2 of them were completely beat up. I had to do total remodels on, as it happens. And I found the combination of the cap rates, the locations, the types of tenants I would have, everything made sense for me to do that. I love 1031. I'm actually the client I'm going out with this afternoon doing a 1031. He closed on it last week. We're buying a couple of properties for him. It depends on everything. Like, for example, going back to Mark's question, who wants to do BRRRR? So it sounds like you're a fix-up guy, Mark. Cheryl, maybe you're not a fix-up guy, and maybe you shouldn't be a fix-up person because the first 3 contractors that you hire will all take advantage of you and take all your money. It totally depends on you. So I invite you to reach out to us or reach out to anybody that you trust and sit down and have a talk because there isn't an obvious answer. There's the right answer for you, and it actually takes some work to get there. And it's a lot of fun, actually. It's really good, but I can promise you it's worth your time trying to get some counsel from people who've done this before to give you an idea of which way you want to go.
And I think, sorry, I'm just I was multitasking, so I think you may have blended two questions together, one from Deborah with the 100K investment and one from Cheryl with the 1031.
Oh, I'm sorry. I probably did. Okay, let me read this again. So Cheryl, what's your personal opinion of 1031 exchange? Oh, God, I'm sorry. I did blend them. Some investors I've spoken to don't utilize 1031s. Do you have a general rule? I love 1031s. I mean, 1031s is about the biggest flippin' tax break the government gives in the world. It is crazy, and by the way, it may go away. It's been talked about for a long time, and there are some serious efforts in Congress, U.S. Congress, to have it go away. 1031s just make all the sense in the world. Basically, what you do is if you own a rental property, you can sell it, and if you take all of the equity out of that property and you buy a property more expensive, then you put it all into the next property and you defer your capital gains, and you can do it as many times as you want. So once again, feel free to touch base if you want to talk more about 1031s, but as a strategy, makes perfect sense. Now, there are things you can do to mess up that strategy, so you don't want to do it. It's not perfect, but if you understand 1031s, it makes a lot of sense.
And actually, one more thing I want to make sure everyone's aware of, because this is a really great event that Charles at Your Castle Real Estate and the guys over at Pine Financial do, is the Denver Investor Success Summit. And I know a couple weeks ago they got the date scheduled for the next one in this fall, which is, I think it's October 28th, so it's a Saturday. And I know the website just got updated recently, so go to denveriss.com. And Charles, you're actually one of the organizers, so give people the 60-second rundown.
Yeah, so we put this together. My buddies at Pine Financial and I, 8 years ago, we just sat down and said, let's do something bigger than a 2-hour class. So we do a full-day event at the PPA. We charge $19. It's just really affordable, just pays our expenses. And the great thing is there's just no selling. We have some vendors there who, people who, title companies and loan companies who have booths, and they help support us, but nobody sells anything. So we speak, we have local experts speak, people come, we just get great feedback, and the fact is it's just a great way to meet people. We'll have probably about 350 people we do this every 6 months, lots of parking, $19, and we actually, believe it or not, buy you drinks afterwards. So if you want a full day of networking, whether you're an agent and want to meet some investors, or you're an investor who wants to meet some agents or other investors or people who are like-minded, definitely please come to this. Just sign up, $19, and we'll see you there. It's a really fun time.
Yeah, and again, the website for that is denveriss.com, so everyone has it. All right, well, we are right at the hour mark, so we'll go and wrap up the webinar. Everyone, thank you for coming out this morning. And let us know, actually, just send me an email or, how you like the new Saturday morning format, something Charles and I wanted to bounce around to get our day started early. And Charles, thank you for getting up early and doing this webinar with me. I really appreciate it. And we're going to sign off here, guys, and we're actually going to spend a couple hours, record some podcasts, and then get out there and look at some properties. So I hope you guys have a great and productive Saturday. Bye, everyone.